Welcome back to this week's On the Spot. Zach Strickland made the short little walk over from the wall. How are you?
Great, Tony. Yeah, so I'm all warmed up now.
I know. And what's funny is that chart that you pulled, I think I pulled the same one, and it's kind of earnings season here, right? It's today you get Knight-Swift, and Monday we had JB Hunt. And JB Hunt's always kind of the first. It kind of gives an insight of what's going on in the market, right? You see revenue numbers strong. Well, you just touched on it, right? You look at kind of where that contract rate is. On the intermodal side, for them, it's like 60% of their revenue, right? So like that's and then they have the dedicated and brokerage side, which make up another 40 or 30% of their total revenue. And you've got 90% of their revenue covered in brokerage, dedicated, which is essentially a private fleet, and then intermodal. So kind of touching on that, Shelley Simpson on their earnings call kind of touched about how what they're seeing in the market, right, especially on the trucking side, the truckload side, the softening in the spot market, which we've touched on for a while now. I mean, you see rejections falling rapidly, spot rates, really going to affect those smaller carriers.
Yeah.
Can you touch on a little of like why that is, why it's the smaller carriers as opposed to these enterprise carriers, not necessarily like a JB Hunt, but like a Knight, where the impacts aren't going to be as large?
Yeah, and Craig Fuller obviously has been writing a lot about this, and that's really what the bloodbath innuendo is these smaller carriers simply don't have the scale to bank cash. If you've looked at any of these earnings reports over the last year, you've got people like JB Hunt, Covenant, Knight-Swift, they've all been banking, like stockpiling cash, which is kind of contradictory. Like probably at the time, some of these financial investors were probably like, why would you do such a thing? You're losing money, and especially in an inflationary environment. But all these carriers, these larger carriers know these cycles have an end. Yeah. and they know that at some point this unsustainable demand is going to fall off, so they didn't go out and buy 200 trucks. Number one, they couldn't get them if they wanted them, but they do have the high priority with the OEMs, so they could go get more than some of these smaller carriers. So these smaller carriers and smaller fleets have to buy on the used truck market, and they're going to not get the same value for purchasing assets as these larger fleets do at scale, because larger fleets have buying power. And the OEMs give them better deals, they give them first access to the equipment, et cetera. So these smaller fleets don't necessarily have that insulation. So they now have to buy at a higher price, and then they're more prone to these swings in the market, because once spot market volumes, which a lot of the smaller fleets have a large dependency on, because you can't build a network at small size. Like you have one or two shippers going back and forth, kind of ping-ponging, and it's hard to identify these shippers that are going to take on a carrier that has 4 or 5 trucks versus a fleet of 1,000 plus, because those 1,000 truck fleet can build a network and supplement these backhauls a lot better. The smaller guys are more transactional. So they definitely need to make sure that they have something that can get them from Atlanta to Dallas and Dallas to Atlanta consistently, with a shipper that has consistent volume. And at small scale, that's hard to find.
Yeah, and I think you touched on a great point there about how they've kind of been, the bigger carriers have been hoarding cash. I looked at Knight-Swift. They've added $104 million to their balance sheet in cash in the past year, which kind of shows like, okay, they're prepping, like that's $104 million isn't a lot of money,
right?
And it can go a long way if you're starting to make investments, but you're investing at the top, which is not necessarily the best thing. And we'll pull up a chart here. It's the chart you just touched on. In the carrier update, it's our van contract rate and our intermodal contract rate, and that spread, I mean, it's at 92 cents a mile, right? And that doesn't include those fuel surcharges, as you touched on. And I mean, there is that benefit to move intermodal. And we see it's a little more regiment, right? We talked about that contract rate on the van side kind of just continuously climbing. Well, the intermodal side, they kind of move through that bid cycle, right? You can kind of see the bid cycle stays. You're not having that
stickier.
You're not having that shorter bid cycle that we've seen talked about in the truckload market. So what you're seeing, I mean, that's kind of that benefit. And now you've got the less timely, the need for that time the time-sensitive aspect is gone.
Yeah, the thing that kind of kept intermodal's rates down, the slower service, lack of equipment availability, drayage issues, chassis issues, all that kind of stuff actually is kind of a benefit now, and you're also getting a discount for it. If you're a shipper that's over-ordered, as many of them have, and have an excess amount of inventory, now all the things so you're getting to ship things that you don't need more cheaply, get some storage at the same time, and you get to stage it. You can just let it sit on a yard.
Yeah.
I'm sure there's going to be penalties and things like that pile up, but it's still far cheaper. While the truckload sector is kind of in that regressionary state, spot rates are falling. By the time you get around to shipping it, you're going to have a much better financial situation.
Yeah, for sure. And we'll kind of transition here into those smaller carriers. We'll pull up another chart. It's from our TCA profitability program. You've got the van operating ratio here on that right axis, and then you've got the spot rate, truckstop.com spot rate, right? Yep. What we see, look in 2019 there on the left-hand side and where those operating ratios were. They're all up around 100, right? Those quickly fell when spot rates jumped there in 2020, right? Yeah. And continued this increase. And that's kind of the best market that these smaller carriers have had in a few years. I mean, it was you hear stories that it's better than what 2018 was. Well, we're still talking about ORs around 95, 96%. So for every dollar of revenue they're bringing in, their operating expense is 96 cents.
Yeah.
So, I mean, they're making 4 cents or 5 cents per dollar that they earn, but that doesn't include interest expenses or taxes.
Which their interest expenses are far higher than the larger fleets, because they don't have the credit rating. They're just getting going. They don't have the cash flow that the larger fleets have. So yeah, it's very difficult at this point. I mean, you're talking about a 93 OR. And that's the best the market could be, or the best the market has ever been. Yeah. That's tough. That's tough to deal with, I mean, especially when you're talking about bouncing. I mean, we did dip a little bit lower there for a little while, but the fact is that inflation is starting to catch up with these smaller carriers. You can see it in these numbers because they've been increasing over the last couple of months. And, obviously 7 cents on the dollar in most industries is unacceptable. Yeah. You're talking about every dollar you spend on moving freight, you're only making 7 cents. Yeah. That's tough, especially when you're talking about these spot rates that are now going to come down. Yeah. If they see significant deflation, now in the price side, that's going to hurt, obviously. But volumes aren't, like the way that they get hurt with their volumes aren't necessarily because of their utilization, which should still be okay for the moment. It's going to be, they're not getting what they were getting $3 a mile for, now they're getting $2 a mile for. And that's going to hit real hard when you're talking about only making a 93 OR.
Yeah, exactly. And then the other side is, right, so you're having spot rates come down, but those inflationary pressures on the maintenance side and the insurance side that go into these operating expenses, they're not going to go away. Yeah. I mean, you still see, especially on the insurance side, you're still seeing nuclear verdicts and things like that put that upward pressure on insurance rates. Yeah. Guess what? They still have to pay it regardless if revenue goes down. It squeezes that margin a lot faster when revenue is declining. Yeah,
and that's the key, is that their cost burden has gone up significantly. And when you're talking about removing that much revenue, and not all these small fleets are purely transactional, but you can assume generally more than 20 to 40% of their overall freight movements are on the transactional side. And so when you're removing a third of that revenue, it doesn't take a lot of math to know that it's going to squeeze those margins real quick, and they're going to have to figure out a way to kind of subsidize these movements. They can't deadhead as far as they used to. We were talking about how in the peak of this pandemic, you could actually, and we heard it from the field, people deadheading from Seattle to get to Los Angeles. Los Angeles has been the fastest retraction in the overall freight market. So in terms of spot volume, spot rates, et cetera.
Yeah, it's definitely going to be an interesting few months, especially as, like we said, these carriers, they don't have an extra $104 million that they didn't have on their balance sheet a year ago, right? So especially on the small side. So will definitely be an interesting time over the next few months, but we're going to toss it to that wraps up this week's On the Spot. We'll be back next week, but right now we'll take a quick break and we will be back with more FreightWaves Now.